Okay, I think we'll make a start. First of all, good afternoon, ladies and gentlemen, and welcome to the Munro Partners webinar. I'm Steve Fletcher, and I'm your host for today. On behalf of the distribution team at GSFM, and also on behalf of Munro Partners, thanks for joining us to hear more about Munro's climate change leaders strategy. We appreciate how busy everyone is right now, so we'll keep the formal part of the presentation on the webinar to approximately 20-25 minutes. And we'll then follow up with your questions, which you can submit at any time in the Q&A box at the bottom of your screen. So just as a way of setting the tone, Munro Partners believe one of the best things you can do when investing is to find structural tailwinds. And Munro would argue today that potentially some of the biggest investment opportunities that we're likely to see in the coming decades lie within those companies that are enabling the decarbonisation of the planet. And to talk more about this today, we have three speakers on the call today, which is great. I have Munro's founder and Chief Investment Officer, Nick Griffin. We also have Portfolio Manager, James Tsinidis, and Munro's Responsible Investment Manager, Mike Harut. So guys, welcome. Thanks for joining the call.
Thanks for having us, Steve.
Thanks very much.
Terrific. Nick, I might just start with you, start with a question. And the Munro Climate Change Leaders strategy is focused on the climate change AOI, or area of interest. And although the fund was launched in October 21, you've actually been investing in this area of structural change dating back, pre-GFC. Maybe as a way of kicking off the webinar, can you talk more about the investment journey so far, if you wouldn't mind? Thanks.
Yeah, thanks very much, Steve, and thanks very much for people who've dialed in and for your interest in the product. So big picture, my job here is just to introduce the opportunity, as you point out, Steve, and why we think the opportunity is now, and why we set up a standalone fund to deal with this. And so first and foremost, Munro Partners is set up to be your global growth manager. We are trying to identify big structural growth opportunities and the resulting winners. Importantly, James, if you just slip through to our key products, importantly, today's webinar is really going to focus exclusively on the Munro Climate Change Leaders Fund. So as many of you know, we do run a number of products here at Munro Partners. We run our Global Growth Fund, which is an absolute return fund. We run a long-only version of the same thing. And about a year and a half ago, we set up the Munro Climate Change Leaders Fund. All our products are also, as you can see, quoted on the ASX as managed ETFs. And so specifically, why did we set up the Climate Leaders Fund? As I often joke with James, who I've worked with for a long time, who actually co-manages this product with me. James and I were around back in 2005 when we were looking at digitalization, we're looking at digital advertising, and we sort of, if we could go back to 2005 and set up a standalone fund, to focus on digitalization, we would, but we can't. It's now 2023. But in the last 3 or 4 years, along's come decarbonisation. As you point out, Steve, we've actually been investing here for 15 years. But we've seen this big momentum shift into the point where we are now going to effectively try and decarbonise the planet. And so what we wanted to do was set up this standalone product. Importantly for clients on the call, this is the product we're going to be talking about mainly, or for the entirety of this webinar. But also importantly, you should think of it as a satellite product or a thematic product. It's a thematic product with just 15 to 25 ideas. It's long only. It runs at a high beta in the market. It's a long-only growth product that really is focusing on these companies that are going to enable the decarbonisation of the planet. And so, James, if you just go to the next slide, that is the key word. And so from our point of view, if you're thinking about this product or you're thinking about offering it to one of your clients, the Climate Leaders Fund is a portfolio of structural climate winners that help enable the decarbonisation of the planet, and enabling being the key word. And so what we're talking about here, companies that are providing the products or the solutions that are going to help us go through this decarbonisation journey. And so from our point of view, that does make it very much a thematic fund and maybe less of a pure ESG product. Mike's on the call today. He'll talk about ESG, but the ESG process we're using here is the same we use across all our strategies. And so why do we want this thematic product that's going to do this? And James, if you just go to slide 12, because ultimately, as I said, in the last 3 or 4 years, you've really seen as an area that we've been investing in for 15 years, the momentum's really picked up. And it's picked up really for a number of reasons that Mike will talk about, but I'll just talk about the big one. which is, the key issue here is the current trajectory of trying to get to a 1.5 degree temperature rise over the next 30 years is ultimately going to cost a lot of money but people have worked out it's going to cost a lot more money than if we don't do it. And so from our point of view, you've seen a range of countries and companies around the world set net zero targets to try and hit this 1.5 degree target. And we think it's going to cost roughly $50 trillion to decarbonise the planet. We've seen numbers higher than that, as high as 100 and even up to $150 trillion. But I don't think anyone on this call or anyone in the world is under any illusions that this is going to cost a lot of money and it's going to be a huge, huge undertaking. I think Bill Gates has called it the largest thing that humanity's ever tried to do. And so from our point of view, if you go to slide 13, we just think from an investment point of view, this is a great opportunity. The reality is if you look at the money that has to be spent, and I've shown this slide a number of times over the years, if you look at this money that has to be spent, it's $50 trillion plus, and it goes across a whole diverse range of industries. We see, it's not just passenger electric vehicles, it's also things like energy efficiency, which is actually a bigger opportunity. It's not just renewable energy, it's things like what you have to do to the grid to make sure that renewable energy works, what you have to do with batteries, what you have to do with hydrogen, what you have to do with heating and cooling. And so from our point of view, that's 50 trillion that you're going to spend in the next 30 years. And ultimately, that's 50 trillion in revenue to the companies that are going to enable that solution. And so that comes back to the point I was saying at the start. Our fund, the Munro Climate Change Leaders Fund, MCCL, is designed to invest in these enablers. Because these enablers are going to get this spending, they're going to get this revenue, and that's ultimately going to equal earnings growth, and that earnings growth is going to equal share price growth. And so from that point of view, we are focusing this from a performance point of view, but also important to stress that the money that you allocate to this product will help go to these solution providers. So that's my short introduction. What I'm going to do now is hand over to James and Mike, who are going to take you through how we're planning on executing on this opportunity and how the fund's positioned today. And I think I'm going to Mike first with you.
Thanks very much, Nick. And really nice to be with you all this afternoon. I think maybe just to start off with, I guess, drilling down into, Nick sort of outlined, the spending that needs to happen versus to decarbonize and how much more expensive it is, not just, obviously for the environment, but for countries and companies and individuals if we don't decarbonize. But is it really happening? And so I think I'll just touch on briefly some of the tailwinds that we've seen really converging to sort of demonstrate that this is actually happening. So we've really for quite a long time talked about these three tailwinds which are converging and really kind of reinforcing and feedback loops reinforcing each other. So starting on the left, we've got obviously the country targets. So this is a global problem which requires a global solution. And one thing that we've seen is the proportion of GDP in countries that actually have committed to net zero. It's gone from 16% in 2019 to now over 92%. So essentially every large global economy has made the commitment to decarbonize. And we've got obviously the annual COP, as they call it, the, I guess, meeting of countries to talk about what they're doing on climate change. And that process iterates and continues on. But it's important to note that's not the only thing. So we've also noticed, and many of the companies that you probably deal with in your day-to-day life, they're themselves, sometimes independent of government, setting their own targets to decarbonize. So we've got a chart there in the middle that shows the Science-Based Targets Initiative, which are targets aligned with getting to 1.5 degrees. The number of companies putting out targets aligned to the Science-Based Targets Initiative, as you can see, has been exponentially growing. And that's supported really by regulators, which are requiring disclosure, as well as in some cases targets around climate change. So why are these corporates doing it? Part of the reason is they're investors. So people like us, we do stewardship, we do engagement with companies, and as do many others, we ask questions on climate change. So there are companies and investors doing this directly, also via groups like Climate Action 100, which is the largest collaborative investor initiative on anything that's ever actually occurred, which is actually specifically targeting the largest emitters and speaking to them on a regular basis around climate change. So, I've got some names there: BlackRock, Australian Super. I used to work personally with the likes of Australian Super and many of the Australian pension funds or superannuation funds, and they're really continuing and sort of leading this work at positioning their portfolios to net zero, and then also engaging with the companies that they invest in around net zero. But back to the country targets, James, if you go to the next slide, I think it's important before touching on some of these key trends that we've noticed. I think one of the key things that's really underpinning the policy support that we've seen is in the US and the Inflation Reduction Act. So, I think we've gone probably less than 10 minutes here. We're already talking about the Inflation Reduction Act. This came in last year. It provides, nearly 400 billion plus of policy support over 10 plus years. And really, I think both of those pluses are important too, because neither of them are ceilings. They actually are linked to particular milestones of decarbonisation. And so as you can see, there are different elements of that. Both clean electricity is clearly an important one, but it's not the only one. And one of the things that's now spurring on is essentially, what some people have termed a subsidy war. So the EU, despite being the leader in this space for decades, really, along with China, to be frank, is now sort of noticing that there's a risk for their industries to be sort of flying out of the EU and into the US. Therefore, they're also trying to respond to that, which again creates investment opportunities. But with that, I'll pass to James to talk, a bit more specifically about some of the particular trends and changes that we're seeing at the moment.
Great, thanks very much, Mike. Thanks all for your time joining us today. Really appreciate it. So yeah, Nick and Mike have probably laid out the long term here, and what we thought we'd do here is just talk a little bit about 2023, because we haven't spoken to clients via these webinars for about 6 months or so. So just want to sort of give you an update on what we're seeing right here, right now, and obviously how that fits in with the very long term that Mike and Nick have just sort of talked about. So 3 key thematics that we've noticed sort of this year, and I'll take you through these, and Mike and I'll take you through these shortly. So the first one's just EV acceleration. In terms of the penetration, i.e. of taking share from ICE, internal combustion engine cars. So that'd be point 1. That's a big talking point in the market at the moment. Point 2 is how the grid is going to keep up here. So as you take more off sort of oil and gas and put it more on the electrical grid, how is the grid going to actually cope with that? Because the grid is very, very old, and we'll touch on that as well. But the third point that we just talk about as well, and this obviously touches not just climate, but all parts of the market, is obviously what's going on with effectively the US-China trade war and 30 years of globalization basically reversing, and how that sort of particularly impacts on the climate stocks. So those are three of the bigger trends that we're following at the moment, and I'll just take you through a couple of those now, or those now. The first one is this big S-curve in EV, and we've talked about this for a while, and the slide on the left-hand side of this screen is basically showing you the curve, penetration curve that we've been talking about for some time. We actually haven't updated this because we're actually pretty much online with what we expected when we put this sort of deck together a couple of years ago. And so you can see we are now at this inflection point where the penetration rate is actually starting to increase quite dramatically now. We're well above the sort of 10% mark. What's also happening at the same time is that the market is basically catching up to this. So you can see here on the right-hand side, the forecast from Bloomberg New Energy Finance in terms of what they expect by 2030. And you can see in 2021, they expected just under 35 million units of EVs to be sold. And they've actually upgraded that view to over 40 million now in 2022. If they did that again today, we'd expect them to upgrade that again. So i.e. the market is basically catching up to what we basically thought would be the trajectory of EV penetration. We always thought it was going to go quicker than what the market had expected. And that's actually beginning to come to fruition. The reason this is actually happening is just on this slide here on the left-hand side. So you can see here, this is just the price cuts year to date in 2023. And this is why this is such a big talking point. This is the price cuts from Tesla. So Tesla is basically accelerating the penetration of the industry, of the EV industry versus the internal combustion engine industry. So you can see the price cuts in China, as well as the price cuts in the US. On top of that, you get this $7,500 credit, which Mike sort of just laid out in the IRA. And that's why the IRA, Inflation Reduction Act, is such a big deal for this industry, as well as a number of these other climate industries. At the same time, as you're getting these price cuts, you're actually getting falling input costs as well. So we're just showing lithium on this right-hand side of the slide, but you could basically show the same chart here for freight rates are well down from their peak, but many other raw material costs as well. So things are basically getting cheaper to produce, and so therefore companies like Tesla are taking the initiative and basically passing that on to clients in a brisk manner in order to basically increase that penetration curve of the industry, i.e. pull the curve to the left. So it's going to happen faster and faster. I'll just hand back to Mike here now, just to talk about maybe one of the bottlenecks to this EV penetration curve, which would actually just be what the pressure this is going to put onto the grid.
Yeah, thanks, James. So obviously the E in electric vehicles stands for electric. And really the grid is old. You know, if you look at the US, for example, 70% of the grid is over 25 years old. Another, I guess, interesting component here is that whilst the grid is a solution to climate change because it enables electric vehicles and other things to be electrified, the grid itself is actually at risk because of climate change. So there has been an increase in blackouts due to climate change. So that's things like bushfires, probably the most sort of obvious example. And the other thing is that as renewables are added, that poses issues around the balance. So you need the grid to work in a different way, in a more sort of bi-directional way than it did historically. And yeah, on the right-hand side, you can see that the electricity demand, again, as we decarbonize, which means as we electrify, the demand on the grid grows. There's an estimate there of 2.7 times what it is today, and it needs an enormous annual spend to actually achieve. So this is one of the sort of things that electric vehicle penetration requires and drives, which again presents opportunities. James, if you go to the next slide, I'll just talk about sort of the third theme, which is sort of slightly different, but it is still, I think, aligned in many ways. So one thing that's sort of happened last 30 years, but then I think it's really been brought quite a lot into focus recently, is this issue of how the climate change and the response to climate change fits in with geopolitics. So we obviously saw it in the context of the Ukraine war, where the EU realized that the question of energy security and the question of decarbonisation actually are more aligned than perhaps was initially thought, because you're not being reliant on fossil fuel imports from other countries. But here we've got slightly sort of different examples. So this is more in the sort of manufacturing of components of decarbonisation. So the more of that sort of industrial manufacturing. So on the left-hand side, you've got the solar demand and supply by the countries in which it's done. So if you look at the solar manufacturing process, you can see, and the little the dotted lines show the change. You can see that China is extremely dominant in many components of, really every component of the solar panel manufacturing process, from polysilicon at the beginning through the wafers, cells, and then the modules or the actual panel itself. As the geopolitical tensions between the China and the US, and to some degree more broadly the West, as that intensifies, there are opportunities really for companies to really offer solutions to their governments really around that industrial base, and to enable them to continue that decarbonisation journey. So there are actually very few names that are probably available to talk about here, but one company that we've invested in at the top there is First Solar, which is a US-based solar module manufacturer, which is now being supported by the Inflation Reduction Act because of the government sees that geopolitical benefit of having a domestic base of solar supply, the solar supply chain. The other example on the right-hand side, again, to what James was talking about, is electric vehicles. So, IRA drives made in USA. So this is a map of the US which shows the new electric vehicle battery facilities that have been announced following the Inflation Reduction Act. So again, at the bottom, we've put in the particular incentives, but what it's really all kind of ultimately driving towards is, the US wants to decarbonize, but it also wants to ensure that it maintains its industrial base or increases their industrial base, so hence that reshoring. but also ensures that the supply chains for these important industries of the future are not at risk of geopolitical challenges. So with that, I'll pass on to James to sort of summarize these three themes.
Great, thanks, Mike. Yeah, so again, the three key themes that we're looking at sort of early in 2023 has been obviously the increase in the penetration of EVs. And down the bottom here, we've just got a couple of logos that we're basically following in terms of the beneficiaries of this. So obviously Tesla's driving this. They're not necessarily a financial beneficiary of cutting prices in the short term, but certainly in the long term, it's the right thing for them to do, i.e. they're going to hold or increase their market share, and they're actually going to increase the rate at which the EV situation, the EVs take over from ICE cars. Tesla's not the only company that benefits here from EV penetration. We obviously have another number of other names in the fund. We've got battery companies like Samsung SDI. We've got power semiconductor companies that we've spoken about in the past, Infineon and onsemi as beneficiaries of that sort of increasing acceleration of EVs. On the grid side, that's obviously the second point that we raised. We've spoken a lot in the past about how everything needs to get electrified, so the demand for electricity is going to go up, and that's going to put a lot of pressure on the grid, and that's obviously going to increase with this EV penetration. These are the companies below that are going to benefit. So some utilities in here, which are responsible for the grid, but also companies like Quanta, which is an E&C company that helps build these electrical wires and so forth. Last point that we talked about was the deglobalization effect. Again, we're looking for companies that are going to benefit from here. Mike just sort of talked about First Solar, which is obviously seeing a big increase in its backlogs from US utilities and developers that basically want to shore up their supply chain or their supply of solar panels. They don't want to be reliant on China, where they could get caught out at the ports and so forth. So First Solar is taking more orders there from US-based customers. They're not the only one. There's other companies like Vestas, etc., like a European company, which in the past has been sort of threatened by Chinese suppliers or Chinese competitors. We probably see that risk going away longer term now. What I'll do now is I'll just quickly talk about sort of current positioning of the fund and how that sort of all feeds into how we've got the portfolio currently positioned. Maybe just as a quick recap, we have shown this slide in the past at previous webinars before. We broadly think about that 50 trillion spend that Nick talked about in that sort of pie chart, basically falling within these four categories, being clean energy, clean transport, circular economy, and energy efficiency. But at the moment, we do have the fund slightly weighted more toward the clean energy side. The reason for that is a lot of these clean energy stocks are in the US or developing in the US, and these are the clear beneficiaries of the Inflation Reduction Act, which we see as a quote unquote sort of game changer. Occurred obviously mid last year, and that's why there is a fairly large weight there to clean energy, as well as for the reasons we talked about with the grid and so forth as well. So biggest position underlying sub AOI within the fund is the clean energy side. Clean transport we obviously still like. We see that sort of EV penetration curve shifting to the left as we've sort of spoken about. So that's a benefit to a lot of these companies. So we're still got a good weighting there. Circular economy we really like as well. We haven't sort of spoke about that in the pre remarks here, but we might touch on that in Q&A hopefully. But we really like the sort of waste management stocks. We see them having a really good sustainability tailwind behind them as well. Energy efficiency is the smallest piece. So think about here as HVAC, heating, ventilation, air conditioning. Think about sort of insulation boards and panels and things like that. That's actually the smallest underlying sub AOI within the fund. And the reason for that is because we're a little bit more cautious around the commercial real estate sector. We think estimates for these companies are still too high, although they do have that very large sort of 24% of the spend allocated to them over a 30-year period, as Nick sort of laid out earlier. In the very short term, we just think that the earnings estimates for the market are probably too high here because we do see some issues with particularly commercial real estate. Valuation of the fund, I'll just show here, and these are a lot of logos in the fund, or all of the logos in the fund. You can see here, a lot of these opportunities are just hiding in plain sight. You have to pay an awful lot of money for them in terms of a valuation perspective. So we think that the fund's pretty well balanced from a valuation perspective as well. Just really quickly, I'll just show you the geographic and sector breakdown here. So the key thing to note, obviously big position in the US. Again, probably unsurprising given you've listened to our remarks thus far. The Inflation Reduction Act is a big piece of legislation. Obviously, the Europeans got to catch up here or have to catch up. and so a bit of exposure there as well to Europe. From a sector perspective, you'll note here a lower sort of allocation versus sort of other Munro funds to sort of tech, higher allocation to utilities and industrials. That's because, back to the premise of the fund, it's about enabling the decarbonisation of the planet. These are the companies that are actually going to build the services and products that basically help us with this energy transition over the next 20 to 30 years. Over time, we would expect the sector allocations for this fund to shift, obviously more towards tech and so forth. But for the moment, these are the companies that are really sort of the new, the green energy majors or the green CapEx winners, I suppose. Last slide I'll touch on quickly here in the interest of time is just performance. And so you can see that the fund did get off to a bit of a rough start in 2022. A lot of growth sort of sectors and companies were down over that period. There was this sort of nice pickup mid last year, and this was basically the IRA. And since then, you know, markets have sort of chopped around a bit, so sort of going a bit sideways. But nonetheless, you know, things are getting better. Things are actually accelerating. We spoke about the EV acceleration. A lot of these green areas are actually accelerating at the moment. So it's probably a pretty good opportunity to basically sort of get similar prices to what we had sort of back in July at the actual initial news release of the IRA, which, as I say, you know, we think is quite a big deal. So that's sort of a quick recap of positioning. You know, why we're positioned this way in terms of the key things we're looking at, you know, at the moment, as well as performance. The other thing people often ask about is just the decarbonisation sort of metrics that we're looking at here. So I might just hand to Mike quickly, just to touch on some of these as well, just so you can get a flavour for what some of these companies are doing in terms of decarbonisation.
Yeah, thanks very much, James. So I think one of the key differentiators for this fund versus many others that it's not so much a low carbon fund, which basically in one way or another just removes high emitting companies. It is more, as Nick outlined, as James, I guess, reiterated, a fund that is looking at decarbonisation enablers. So while the actual operational emissions of the companies, so what they actually emit in running their business, whilst that is important, which is the scope 1 and 2 emissions on the left-hand side of the chart, we're really fundamentally much more focused on what the actual products or services of these companies help avoid. Now, the challenge here is quite significant from a data perspective, I suppose, because whilst I think many companies now do have really strong scope 1 and scope 2 emissions data, and I should just emphasize that we haven't included the scope 3, primarily because of data quality, but as it says in the footnote, the difference is still the same. It is a challenge to actually put together the data on the emissions avoided. So what we've done here is simply just show 4 companies. So the portfolio is, you know, as James said, at any point in time, you know, 15 to 25 companies. We've just picked out 4 companies here, one from each of the sub-themes. So waste management in the circular economy space, Kingspan in the energy efficiency, Vestas in the clean energy, and Tesla in the clean transport. And I just looked at, you know, their own, the emissions avoided through their actual products. So, for example, in Tesla's case, it's the difference between an electric vehicle and an ICE vehicle multiplied by the number of vehicles essentially that Tesla sells. And the bottom line is, if you just look at just these 4 companies, what they help enable through their products is, as you can see, many multiples of what all of the companies together actually emit. So whilst we don't have a specific objective around these metrics, this is something that we actually do monitor quite closely, because, you know, a company that is enabling decarbonisation really does need to obviously demonstrate that it does so. And we think that the fund, you know, does really track quite well from that perspective. Yes, whilst we have industrials and others in there that emit a lot in terms of their operations, what they help avoid through the products or services that they ultimately have is, as you can see, you know, a much bigger impact of those companies. So with that, I'll I'll stop there and we can get on to questions, Steve.
Terrific. Thanks very much, Mike. I might also invite Nick back for question time. Thanks, Nick. So we've got a few questions coming through, and if you've got more questions, please feel free to ask those now. One question coming through is that many agree that it certainly is a compelling thematic, but it's not like it's a secret, in brackets, as you said, hiding in plain sight. Yet the market is not embracing the theme right at the moment. Why do you think that's the case?
Yeah, I can start off there, Steve. There's probably a few elements to that. So, I mean, maybe just to address this, where I did say sort of hiding in plain sight. I suppose what I'm meaning by that is that the market, like a lot of areas of structural growth, just is pretty much incapable of pricing in the longevity of growth as well as the level of growth as well. So what we're seeing is, because a lot of these technologies are newer, basically analysts aren't putting them into their numbers. So if I just pull out an example here, I'll just talk about waste management as a waste management company, and hopefully that sort of brings that to light as to why, yeah, sure, it's not a secret, but it's just not in the numbers. And hopefully this can answer that. So the market basically models waste management as its traditional business, which is basically going around the homes in the US and picking up the trash and dumping it in landfill. It owns the landfill, it owns the trucks, it owns the transfer stations, etc. It gets paid really well to do that. It's a really, really good company. It's very defensive, very high barriers to entry, very strong market share. What the market is unable to basically price in at the moment, because it's a newer opportunity, is basically the increased EBITDA that the company can get from doing a couple of new things. So the first one is just recycling. The US has been very poor at recycling. They're now putting in automation to be able to recycle and basically generate revenues from basically this recycling opportunity and selling the product back to their customer, corporates, for example, because those corporates like Coke, Pepsi, etc., as we know, have issues around sustainability, particularly around plastic and so forth. So that's opportunity number one, that the market is not really putting into the numbers. So Wall Street analysts are not putting it into the numbers yet because it's not yet visible to them. The other opportunity, which we think is a bigger opportunity, is actually the renewable natural gas opportunity. So in Melbourne, we have the green bins. Obviously, people are used to putting their garden waste, food scraps, etc., into the green bins. They take it away. This doesn't occur most of the way around the world. I'm not sure what colour the bins are in Sydney and Brisbane and elsewhere. Sorry, but I'm sure you got the same bins, right? What waste management is trying to do, and the other waste management companies now, is actually capture the renewable natural gas off the landfill and actually sell that back to other companies, or they can use it in their own fleets as well. So, and within the US IRA, I know we've sort of sounding like a bit of a broken record, but there's now a price or a credit that you get for this type of activity, because it's basically better for the environment. So all in all, the type of work that we do, and a couple of our colleagues were overseas in Texas not that long ago to do this work, to sort of meet with these companies to understand the magnitude of what they could actually produce. It's actually quite a material upside to the EBITDA estimates in the market. So, the market's actually about 15%, 10 to 15% too low in terms of what we think the company can actually generate. So all else being equal, share price actually should move up 10 to 15% as these opportunities are basically put into people's numbers. So that's why we sort of say it's hiding in plain sight, but it's not sort of in the numbers yet. Sorry, that's an incredibly long answer to maybe a clarification point there. Steve, can you remind me what the second part of the question was? So hiding in plain sight, but why is
it was more just about the market's not embracing the theme right at the moment. So it was really more around the sort of timing of an investment. Yeah.
Okay, yeah, sorry. And probably the reason it's not, the market is not sort of embracing. So maybe on this line here, you can see the initial move higher in the purple line, which is the fund, on the back of the excitement around the IRA. And we've sort of been tracking sideways. First of all, I mean, the market isn't exactly trading well more broadly for a while now. So that's, obviously, the stock is a long only, the fund is a long only fund. But secondly, obviously, there has been some delays around the IRA. i.e. around some of the like tax implications, the IRS, etc. So as usual, you know, you get the big government policies and then it's sort of, you get that initial excitement and then it sort of, you know, trickles out over time a little bit more. So the companies don't actually give you the updated guidance because they don't yet know the tax implications. We expect that to start to occur now. It actually is due. There's more stuff due at the end of April from the IRS. And so we would expect the companies to start to actually put this into their guidance. A little bit like what I just explained with the Wall Street analysts and waste management, like something that's clearly there, something they can clearly do, something that you can clearly figure out what they're going to get paid for. But it's probably too early because the company hasn't given, well, not all the companies have given explicit numbers around this yet. So a little bit the same with the companies not quite factoring in the IRA just yet. So, you know, as a buy side fund manager, you can sort of get ahead of that, and that's the opportunity, I suppose.
Okay, thanks, James. Next question, any high level take on Chile looking to go down the route of nationalising lithium mining?
Okay, Nick, do you want to take that one? Or do you want me to?
Yeah, I can take it quickly. Look, so from our point of view, it's clearly not great news for lithium. Well, look, we don't have a lithium investment in the fund today. And you know, we haven't really had one since it started. Lithium is an abundant commodity. And so from that point of view, there is opportunity with the lithium miners as this S-curve accelerates. You know, the reality is it's almost impossible to bring on enough supply to satisfy that. And that's why you've seen this big rally in the lithium price and then has since come off more recently, you know, with you know, slowing orders in China, et cetera. And so this is all part of the puts and takes of the lithium market. And so ostensibly it's a great opportunity. But when you look into the nuts and bolts, you know, we don't sort of get that wonderful 5-year earnings growth trajectory that James just went through on waste management that makes us feel comfortable to invest just yet. So we're not invested at the moment. We're watching this development. You know, it's potentially going to create an opportunity for us. In the long run, the lithium's got to get out of the ground and people are going to be paid a price. So there's clearly an economic return there for the winners, and we're monitoring them today.
Okay, thanks, Nick. Next question just around on Tesla. So we know Tesla's Scope 3 emissions are substantial due to supply lines. So arguing Tesla removes carbon from driving is simplistic. Have you got any comments just around that?
Yeah, do you want me to take that one? Yeah, so we use Tesla's estimates of life cycle emissions of their cars versus internal combustion engine vehicles. So it includes the production process to make the car, as well as obviously the emissions of the vehicle once it's being driven. So if you look at the data, it suggests that it's about 70 tons of CO2 for an internal combustion engine vehicle versus about 30 tons today for an electric vehicle. And so essentially, so that's the difference based on same miles driven and all of that, including all the scope 1, 2, and 3 emissions. The other interesting thing here to note is that it's almost impossible to decarbonize the internal combustion engine emissions, tailpipe emissions, whereas as the grid itself decarbonizes, that 30 tons of CO2 of a electric vehicle actually has the potential to go down, you know, maybe not to zero, but to actually essentially increase that differential between the total life cycle emissions of an internal combustion engine vehicle versus an electric vehicle. So that's the sort of the basis for our assumption here. This data, you know, the IEA has essentially the same has reached essentially the same conclusions of the climate benefits of electric vehicles versus internal combustion engines. So we obviously we fact check and verify the claims of individual companies, but that's the basis for it.
Okay, thanks, Mike. Next question. You mentioned the EU is looking at its own subsidies. I understand so are other countries like Korea, India, and Japan. Do you know what the state of play is with other countries trying to emulate or keep up with the US, and how much money is being earmarked for it from governments?
Yeah, maybe I can start on that one and Mike can jump in. But look, the obvious fast follower needs to be the EU. I think Mike mentioned earlier, the EU has traditionally been in the lead of a lot of these sort of green energy majors of the future that we see coming down, as being, the new Exxons and Chevrons of the world. A lot of those companies were European to start, and the US is sort of leapfrogging them, I suppose. We were quite excited sort of late last year that you'd get more coming out of Europe to respond to the US. And thus far, it's been a little bit on the disappointing side, just because, as usual with Europe, you need all the countries to agree. So, the problem is that obviously Spain has different industry to Germany, and when the EU as a group tries to come out and protect the European auto industry, for example, against Tesla, the Spanish will rightfully say, hey, Germany, this is just looking after your German auto workers, right, or your German auto industry, and vice versa. If it's solar, there's not that much sun in Germany, there's plenty of sun in Spain. And if the EU policies are seen to be too much slanted towards helping the European solar industry, then the Germans will say, well, this is helping the Spanish, not the Germans. So that's sort of the key problem with Europe. Look, hopefully they do get something material going, but at the moment it looks, from my perspective, it looks as though the Europe's falling behind, and you can see that the European companies themselves are voting with their feet. So they're moving to the US. They're doing deals in the US, trying to get US production and development going. They're coming out to Australia, etc. They're not actually doing that much in Europe. So Europe probably needs to get its act together, from my perspective, from what I'm seeing. So, but Mike, would you add anything there?
Yeah, I mean, one thing which I'd just add is the interesting thing with the IRA specifically is that it does provide opportunities to other to other countries. So, for example, the Korean battery manufacturers are kind of indirect beneficiaries of the IRA as well. It's really more the Chinese ones that aren't. So I just add that element as well.
Yeah, thanks, Mike.
Okay. Moving along to nuclear energy. Do you have any investment interest in nuclear energy, or likely to in the future?
Yep, we do have a position in a company called Constellation Energy. It's the largest US nuclear energy producer. Nick, do you want to talk about that one? We've spoken to the company quite a few times, obviously. Recently.
Yeah, so from our point of view, nuclear is part of the renewable energy fix. I think there's a slide in here, James, just really quickly, but there is. Yeah, if you think about what the US has to do, which is to effectively, decarbonize alongside the IRA, they need to change their energy mix towards renewables, and what they can't afford to do is close down their own nuclear plants. So nuclear makes up, I think, roughly 18% of all electricity in the United States today. 19, missed it by one. And so from that point of view, you're probably not going to build any new ones, but the existing ones become very, very valuable. And so in this case, Constellation Energy is the largest existing owner of nuclear fleet in the United States. Those plants were slated to close in the next 10 to 15 years. They're probably not going to close for the next 80 years. So the value of those assets goes up. Secondly, they get supported by IRA credits because of renewable energy. So there's a put on the earnings that these companies can earn, or a floor now based on the credits. And thirdly, if you're going to build hydrogen and things like that, and I'm sure some people want to ask about hydrogen needs a lot of renewable fuel. Most of that renewable fuel, the largest source of renewable fuel today in the United States is nuclear. So they have these opportunities to grow. So what were boring power companies, talking about things that lying in plain sight, that what were boring power companies are now growth companies. And so Constellation is the one we like. We're not into micro reactors at the moment, or new nuclear fuel, and we don't own uranium, but that is our nuclear holding today.
Okay, thanks, Nick. We're going to circle back to Tesla. In the case of Tesla, are you comfortable with the move to increase volume at the expense of margins? And are you concerned that Elon Musk is distracted and somewhat erratic?
Yeah, I can take that one. I mean, short term, as I mentioned, it's a negative for profitability for Tesla. Obviously, when you're cutting price, your margins go down. But we think it's absolutely the right thing for the company to be doing long term. We do have a position in Tesla. It's not a large position for this fund. We've sort of been, sub 5%. We'd love Tesla to be the biggest position in this fund longer term. but we are aware of these sort of shorter term issues as the company is trying to, I suppose, promote EV adoption and obviously trying to sell cars as quickly as possible. We're comfortable with their strategy basically because our work, and the same two guys that were over doing the work on waste management, renewable natural gas, actually also went over to the Tesla Investor Day, which was last month. I think it feels like longer ago, but it was only just recently. And the key conclusion from that day, and also obviously, we've spoken and met with the company many, many times over the last few years, is that the company does have a technology lead. I won't go through this whole slide, but basically we think that they continue to drive efficiency through things like automation and so forth. And ultimately what they're going to end up doing is getting the price down to such a level that their cars can compete with sort of your mass market cars like your Toyota Corolla, as you can see there at the very, very bottom of this slide. And so at that point, basically, we think that the EV adoption curve speeds up again. And obviously we want Tesla to be, a key market share player at that point in time to sort of execute on this very, very large total addressable market opportunity. So, we do think that in 10 years, you'll look back and say, oh, well, they cut price in, early 2023. The share price went down on the back of it because the short-term numbers for 2023 EPS expectations went down. But 10 years later, it'll be proven to be the right decision. The reason it'll be proven to be the right decision is because the total addressable market is just so large. So we've been showing these two slides for a while now, 59 and 60. You can see the size of Apple. This is the analogy we use in terms of its market cap versus the actual size of the global mobile phone market. On the left-hand side here, on the right-hand side, you can see the car market. It's obviously significantly larger than the mobile phone market, but Tesla's still a fraction of, market cap-wise, is still a fraction of Apple today. So, you can see the very large sort of TAM and why, this company could ultimately end up being bigger than Apple. And I think actually Elon Musk has said, he could be, or Tesla can be, as bigger than Apple plus Saudi Aramco together. We've got some basic sort of assumptions here as to why, we do think that, this is potentially the biggest company in the world one day. And these are obviously aggressive assumptions, but I think it is, or some of these are aggressive assumptions, but, I think it is important to recognize that today the company does have over $100 billion of sales. So, it's a real company. It's gross margin positive, obviously. And so that's why it can afford to cut price. So, and it's in its balance sheet's in good position as well. So, we think that they're absolutely doing the right thing longer term. Okay,
thanks. Another question on Nvidia. Nvidia appears as one of the holdings in the fund. Can you elaborate on how the semiconductor is enabling or benefiting from the move to decarbonisation?
Yeah, great, thank you. So Nvidia sits within this energy efficiency piece. We don't actually have a slide on it in here, but Mike, maybe you could quickly talk about why we think the stock fits in this fund.
Yeah, absolutely. So it is one that we initially debated quite a lot, but I think there's essentially two reasons. So data centers make up roughly 1% to 2% of global electricity use today. And that may increase as, one of the other things that we've been talking about is artificial intelligence and all the sort of computing power that's required to actually achieve that. So this is not an area that's kind of decreasing in terms of size. NVIDIA's key role here is that CPUs, as we move from CPUs to GPUs, it's a 20 times less energy required for the same computing power. So and NVIDIA essentially has the best semiconductors, which enable them to really kind of lead in terms of the energy efficiency of their semiconductors. And so as that change happens, it's the equivalent of something like 1.7 million homes, their electricity requirements. And so, from that perspective, it's a decarbonisation enabler. To me, actually, what's sort of more exciting about NVIDIA and the opportunity is around, their ability to enable essentially more efficient industrial operations and design. So I encourage people to Google NVIDIA and BMW and the work that they're doing with BMW, for example, as a customer, where essentially, BMW wants to make a new factory. Through NVIDIA's capabilities, they can essentially create a digital twin of that factory, which allows them to test and optimize the design of that factory to make it as efficient as possible to degrees that were pretty much impossible without that sort of sophisticated, detailed modeling in these sort of digital worlds that can be created using the sophisticated chips that Nvidia has. So really, it's those sorts of things. So it's both of those things. So it's the more efficient computer processing in data centers, and secondly, the actual use of that product for things like creating digital twins for car factories and whatever else, as well as probably thirdly the physical climate modeling, which they're also helping with as well.
Okay. And maybe I'll just jump in there and make one comment. It's just maybe important to flag that, from our point of view, a decarbonisation enabler is a company that has more than 50% of its revenues come from products that help enable the decarbonisation of the planet within the next 5 years. And Nvidia passed that test fairly easily because most of its products go to things that help enable the decarbonisation of the planet because of exactly what Mike just talked about. And so that's the test that we use when we discuss these things. And we try to manage within that test, and Nvidia did pass that test.
Okay, thanks. Nick, you sort of touched on this a little bit earlier, but Munro's view on the role of hydrogen in decarbonisation. Have you got any comments on that?
I'm going to let James take that, actually.
Okay.
Yeah, so hydrogen, I don't actually have slides specifically on hydrogen here. So apologies for that. But look, hydrogen's about sort of decarbonising some of these tough industries to decarbonise, being like heavy transport, steel manufacturing, etc. I don't even have a slide that I can sort of point to here. I apologise. Yeah, so basically, we're going to need hydrogen for that. And so, actually, I can show this one here, I think. No, actually, this isn't going to help. So decarbonising hard to decarbonise industries. So think about air transportation, shipping, trucking, etc. Because the conventional wisdom at the moment is that you can't really do it with electric vehicles because the batteries are just too heavy. And so you're going to need hydrogen. To produce hydrogen, you need a lot of renewable energy. And so this is a potential benefit or another tailwind for companies like these ones here that produce that renewable energy, as well as some of the companies that handle industrial gases today. And we just point to sort of Linde, Air Products, companies like that. So we actually own Linde in this fund for that very reason. It's going to be integral to some of these sort of green hydrogen opportunities. And in a lot of cases, got sort of JVs with some of these sort of utility type of companies as well, these sort of renewable developers as well to produce that hydrogen, as well as obviously, as Nick said, with the nuclear derived hydrogen as well. So yeah, we see that as another big opportunity. It's probably further out. So a lot of these big projects are sort of late this decade, maybe even into the 2030s. And so today we really only have a couple of sort of stocks that are geared to this. Really today we're sort of more focused on these areas that are accelerating today, being EV penetration, clean energy, etc.
Okay, great. Well, thanks, James. Well, look, I think we've got time just for maybe some closing comments. Nick, and I might hand over to you for any final words.
Yeah, look, thanks very much. And thanks everyone for your interest. Look, so from our point of view, a couple of things just to flag. One, we're really excited about this product on a long-term view. It's important to stress that, since we launched this product, yes, there's been volatile markets, but everything that we launched it for has actually got better. From that point of view, the US has passed the IRA. Russia, unfortunately, invaded Ukraine to force European to switch faster. And companies have only got more and more focused on this since we talked about this a year ago, and countries have only got more and more focused about it. So the opportunity is actually accelerating even faster than we thought when we launched the fund. And in many cases, the share prices are lower. And so from our point of view, the opportunity is beginning to accelerate. And I know the market isn't appreciating it maybe as quickly right now, but we do think this is the next big opportunity for the next decade. Second thing just to flag is, we are very transparent. The product is as an ETF. So you can go to our website and you can download the fund. We publish every stock in there on a 30-day lag. And so feel free to look at it. feel free to look at the companies that we're investing in and be comfortable with that. And so from my point of view, the simple way to describe this fund is that you can buy MCCL today, and tomorrow you're going to wake up and own 15 to 25 of the companies that we think are helping to enable the decarbonisation of the planet and ultimately going to profit from it. Last thing, we fully expect to continue to do these webinars over the years. We're going to continue to work on this framework, and these are the areas where we think that decarbonisation is happening now. And most importantly, as James said, to focus on the ones that are accelerating today. So please use our website, please use our materials, please use the transparency that we provide here for yourself and for the clients to hold us to account that we're actually doing what this product says on the tin. And so from that point of view, thanks very much for listening. Looking forward to seeing how this opportunity plays out in the next 10 years, because I think we all agree it's there. And our job now is to be your active manager here and to go find these good positions and not do it in an ETF form, do it in a concentrated form where we can find them and benefit from them. And like all of our best areas, find those few winners that are going to help enable this decarbonisation. That would be my final comments.
Terrific. Well, thanks, Nick, for those comments and your presentation, and also thanks to James and Mike for your presentation as well. Much appreciated. Ladies and gentlemen, thank you for joining the call today. We appreciate it. As Nick just alluded to, as a reminder, the Munro Climate Change Leaders Fund is available on platforms and also via the ASX, as is the same for the other funds that Munro offer, the Absolute Return Global Growth Fund and also the Munro Concentrated Long Only Fund. We'll provide you with a copy of the presentation today, and should you have any questions, please don't hesitate to contact your GSFM account manager. Once again, on behalf of GSFM and Munro Partners, thanks for taking the time to join us today, and we look forward to seeing you all again very soon. Thank you.